Today, we will talk about what a bond fund is and how it works, including its benefits, taxes, and types. A bond fund, also known as a debt fund, is an investment vehicle that pools money from multiple investors to invest in bonds and other debt instruments, such as mortgage-backed securities. The primary goal of a bond fund is to generate income for investors through interest payments and potential capital gains. A bond fund is a type of mutual fund that invests solely in bonds. Investors put their money into a pool managed by a portfolio manager, who buys and sells bonds according to market conditions. Unlike individual bond securities, bond funds do not have a maturity date, and the principal amount invested may fluctuate over time. Investors receive monthly interest payments based on the mix of bonds in the fund. There are different types of bond funds, such as government, municipal, corporate, mortgage-backed securities, high-yield, emerging market, and global bond funds. They can be categorized by the type of bond, time period to maturity, or asset class. U.S. government bonds are considered the safest, while high-yield bonds offer higher potential returns but come with more risk. Bond funds are attractive to investors because they provide instant diversification and access to professional portfolio managers. They also have lower required minimum investments compared to individual bonds and offer easier participation with lower transaction costs. Additionally, they can provide higher after-tax yields for investors in higher tax brackets. Bond funds are subject to capital gains or losses when sold and can be impacted by changes in interest rates. Long-term bonds carry greater interest rate risk than short-term bonds, which can affect the fund's net asset value and monthly interest income distribution. Some investors may find higher after-tax yields from tax-free municipal bond funds. Bond ETFs are similar to bond mutual funds but are traded on the open market like stocks. They often have lower fees and trade throughout the day. ETFs can provide an alternative choice for investors, especially those seeking lower fees and more liquidity in their bond investments. Here are 3 key takeaways. 1. A bond fund invests primarily in a portfolio of fixed-income securities. 2. Bond funds provide instant diversification for investors for a low required minimum investment. 3. Due to the inverse relationship between interest rates and bond prices, a long-term bond has greater interest rate risk than a short-term bond. Hope this would help. Thanks for watching.